You work 40 hours a week. You're responsible. You spend carefully. You follow the rules. And yet, it feels like your bank account has a leak you can't find. That's because the financial system isn't just a tool for exchanging money. It's a complex structure built on rules most of us were never taught. From the invisible tax on your morning coffee to the quiet way inflation reshapes your future, there are forces at work behind the curtain. If you want to stop being a pawn in the system and start understanding the game, you need to know these pillars of the modern world. Let's begin. 1. Taxes, the modern ritual. Imagine working all month and earning $2,000. But when payday arrives, you see $1,456. Where did the rest go? Before you even touch your money, income tax, Social Security, and Medicare have already taken their share. We're told it's the cost of civilization, roads, schools, public safety. And that's partly true. But taxes also fund projects far beyond your daily life. The system collects its portion automatically, quietly, and efficiently before you ever see the full number. It's not random, it's structured, and it's designed to operate without your participation. 2. Banks, the great illusion. When you deposit $1,000 into a bank, it feels secure. You imagine it sitting safely in a vault. But in reality, most of that money doesn't stay there. Through fractional reserve banking, banks keep only a fraction of deposits on hand. The rest is loaned out to someone financing a car, a house, or yes, even a jet ski. The system works because not everyone asks for their money at the same time. In return for holding your funds, the bank might pay you a fraction of a percent in interest. Then it lends that same money at significantly higher rates. You provide the capital, they capture the margin. Understanding that dynamic changes how you see your savings account. 3. Interest, friend or assassin? Interest is simply the price of money. If you borrow, interest is the rent you pay for using someone else's capital. If you invest, it becomes your reward for patience. Simple interest grows steadily. Compound interest grows exponentially. At 20% credit card interest, debt multiplies. A small purchase can quietly expand into something far larger than expected. But the same force works in your favor when invested wisely. Over decades, compound growth becomes one of the most powerful financial tools available. Interest doesn't care who benefits, it simply works. The question is, are you paying it or earning it? 4. Inflation, the invisible thief. Have you noticed products shrinking while prices rise? That's inflation. Inflation reduces the purchasing power of money over time. It often happens when too much money enters the system while goods remain limited. When demand rises faster than supply, prices increase. To slow inflation, central banks raise interest rates. Borrowing becomes more expensive, spending slows, growth cools. But in the short term, that cooling often feels painful. Inflation moves gradually, quietly, and if your money isn't growing at least as fast as inflation, you're losing ground, even if your bank balance looks the same. 5. Recessions, the economic reset. Think of the economy like a long party. During expansion, businesses grow, jobs increase, optimism spreads. Eventually, imbalance builds, rising debt, high rates, global disruptions. Then momentum slows. A recession is typically defined as 2 consecutive quarters of economic decline. Businesses contract, layoffs increase, confidence drops. It's uncomfortable, but it's also part of the cycle. Recessions reset excess. They expose weak foundations, and they reward those who prepared during stronger times. The cycle always continues. The question is whether you move with it or react to it. 6. Credit scores, the shadow algorithm. Somewhere in a database exists a 3-digit number that influences major parts of your life. Between 300 and 850, your credit score doesn't measure wealth, it measures reliability. Do you pay on time? How long have you borrowed? How much debt do you carry? Lenders use this score to evaluate risk. A strong score lowers borrowing costs. A weak one increases them. It's a system built on behavior patterns, predictable and mathematical. Ignore it, and it works against you. Understand it, and you can make it work for you. 7. Currency, a shared belief. Here's the deeper truth. Money has no inherent biological value. A $100 bill and a piece of paper are physically similar. What makes one valuable is collective agreement. Currency works because we trust it works. Governments manage supply carefully. Too much printing weakens purchasing power. Too little restricts economic activity. Modern money is a social contract. Its strength depends on confidence, and confidence is fragile. 8. Investing, the long-term advantage. If inflation erodes value, investing preserves and grows it. Instead of trading time directly for money, investing allows capital to generate more capital. Stocks represent ownership in companies. Bonds represent lending. Real estate represents tangible assets. Each carries risk, but avoiding investment entirely carries its own risk, the silent erosion of long-term purchasing power. Wealth is rarely built overnight. It is usually the result of time, discipline, and compound growth working quietly over decades. Time magnifies consistency. 9. Value in time, the real currency. Why does one profession earn more than another? Perceived value. Compensation reflects how much impact, leverage, or scarcity a skill represents in the marketplace. But beneath everything lies a deeper asset: time. Time is finite. Most people trade hours directly for income. Others build systems, skills, or assets that multiply the value of each hour. Understanding this distinction changes how you approach your career, your investments, and your decisions. Because in the end, money can be regained. Time cannot. Most people move through these systems without examining them. They earn, they spend, they repeat. But now you see the gears turning behind the surface. Look at your bank statement differently. Review your interest rates carefully. Consider how inflation affects your long-term plans. Financial literacy isn't about memorizing terms. It's about recognizing patterns. And once you see them, you can't unsee them. If you're ready to understand the hidden rules shaping technology, psychology, and the economy, subscribe and stay connected. The next deep dive is already underway. Stay sharp and get to work.